Investors Chronicle.
Hello and welcome to Lee and the IC, the podcast in which you, dear listener, get to hear from one of, if not the best known UK private investor, Lord John Lee of Trafford. It's Wednesday the 5th of March as we record. Markets are in, as they have been over the last couple of weeks, a bit of a state of disarray as they try to pass the whiplash-inducing effects of a Trump presidency. But we're here to find some calm and slightly longer-term reflections beneath the chaos. John, how have you been?
Fine, thank you. Watching recent events with interest.
Yeah, may we live in interesting times, as they say. This month, we're going to be briefly checking in, as we always do, on the latest happenings in your portfolio. And that prompts my standard disclaimer that nothing we discuss on this podcast should be construed as investment advice. As ever, we urge you to do your own research. But for the bulk of this month's episode, we're going to be speaking with the CEO of one of John's companies he invests in. That company is the Equipment and Outsourcing Group, VP, whose CEO, Anna Bealby, joins us over the line from Leeds. Anna, thanks so much for speaking with us today. Can I start by just asking you to provide a brief introduction to VP, its kind of divisions and corporate history for those listeners who may be unfamiliar with the company?
Yes, I will do. Firstly, thank you. Good morning. So VP is a specialist equipment rental business, got a rich heritage. It was founded 70 years ago. We supply specialist equipment to our customers, and that's customers who, for whatever reason, would rather hire equipment from us than buy it themselves. We've got a wide variety of customers. At the upper end, we deal with the likes of Network Rail and Balfour Beatty, and at the smaller end, we deal with a number of medium-sized businesses. The sort of equipment that we rent out is quite diverse. It ranges from small test and measurement equipment through to large items such as air compressors or telehandlers. We operate in 4 end markets: infrastructure, in construction, in energy, and also house building. Most of what we do is in the UK market, but we do have activities outside of the UK, both in Europe and also in Australia and Asia. And about 50% of our revenue at the moment is outside of the UK. This business has grown over the years in a number of ways. It's had a really good level of organic growth, but acquisitions have also been part of the story. And we made our latest acquisition in October last year, which was a powered access business over in the Republic of Ireland. Over the last 20 years of VP, the focus has been really around us being a specialist. And that means that either the assets that we rent out are specialist assets, or it means that the way we offer our assets is specialist, i.e. it's asset plus people, or it's asset plus design. So it's wider than just the asset. Or we operate in very specialist end markets. We think that focusing on specialists gives us good barriers to entry and high returns. We're made up of a number of specialist divisions. Historically, those divisions have operated quite independently, but our strategy at the moment is focused on those divisions working together to support on major customers and major projects.
Great. And can I just touch on from a personal perspective, where does your involvement with VP trace to?
I joined VP just over 2 years ago in January 2023. And at that point, I joined the business as CFO because my background is in finance. And when I had been in the business for about 6 months, the existing CEO retired, and I was asked to step up and take the CEO role. So of my 2 years in the business, 6 months was in the finance role, and 18 months has been with overall leadership as chief exec.
John, can I just bring you in just so we all know what page we're on, and what's your history been with the company?
Well, I was looking in my records, before coming today, and I did become a shareholder in VP in 2003, and actually bought the shares and sold them within that year at a small profit, and I think it was a fairly modest investment in those days, and we're talking well over 20 years ago, aren't we? But I do remember going to the AGM. Would it have been was it Rudding Park, Anna?
It would have been Rudding Park, and we still held our AGMs at Rudding Park today, yes.
Right. So, I remember going over there and meeting one or two of the personalities. And then I didn't really have any contact with the group at all as an investor until 2023, a couple of years ago, when in putting my portfolio together, looking for solid established companies that were profitable, that were showing an attractive dividend yield. I think in the case of VP, approaching 7%, and shares that really looked to me quite significantly undervalued. VP ticked those boxes, and so I became an investor again in VP a couple of years ago, and have built up my holding since then.
Anna, if I may just ask a very basic question, I know you kind of outlined the nature of the business there and specialization, etc. To better understand your business model, your customers use your equipment all the time. You charge a premium to use your equipment, presumably. Why don't they own it instead?
It's fair to say that one of the biggest risks to hire is customers choosing to buy the assets themselves, but there are a number of reasons why people would choose to hire rather than buy. I guess the first one is it helps their balance sheet because they don't have to invest in the asset. And also, you say our customers use our equipment all the time. I guess the answer there is it depends. So some of the customers might use our equipment for a relatively short period of time. Some it might be a bit longer, but it gives customers the flexibility with their own balance sheets. Secondly, is complexity. The nature of assets that we have can be quite complex in their nature because they're specialist. And therefore, it sometimes needs some of the stuff that we do in addition to the asset, for example, the design, for example, the people that can operate the plant and some of the engineering work. So it might not just be the assets that they are getting from us. And the third one is I suppose, risk. Some of the environments that our assets operate within are quite dangerous, and those assets need to be regularly tested and calibrated, and training and qualification is required. And our customers can get that assurance from us if they're hiring our assets, whereas if they held them themselves, there'd be quite a lot of work they'd need to do to ensure that all of those certifications, etc., are in place. So I think there are a number of reasons, but the main one from my perspective is it gives them financial flexibility in terms of their own balance sheets and their own investments.
And as to your own balance sheet, I mean, I see, for example, that you provide servicing rescue equipment at Hinkley Point C. I mean, it sounds very, very specialist work. Is that kind of equipment that you'd expect to sell on after the nuclear site is live at the end of this decade or next decade, whenever it does complete? Or would you expect to redeploy it at another project, or are things a bit more complicated?
We consider ourselves to be custodian of assets, and what we do is look after our assets throughout that life cycle. So from putting the asset through to owning it from a period that might be as short as 3 years, it might be as long as 20 years, and then disposing of it a bit at the end. Usually our assets are used on a number of projects, and therefore when project A finishes, they'll move on to project B. But if assets are no longer required on a project, we will dispose of them. And actually receiving proceeds at the end of an asset's life is an important part of our model. We obviously invest quite a lot of money in our capital expenditure, but we also receive quite a lot of money from proceeds because we are turning our assets over relatively quickly, because having a young, well-maintained fleet is an important part of the model.
Rail, I know, has been a big emphasis over the last year for the group. I mean, that's just one of many sources of infrastructure demand, which are clearly very huge in the markets you operate in. And we hear a lot of talk about the demand for infrastructure. Can you just talk to me a little bit, maybe focusing on the UK as kind of a core market example, your take on the supply? Is it there? Is it ready? Do you see the either local authority or national impetus to get infrastructure projects off the ground where you would like it to be?
So infrastructure is probably about 40-ish% of our business from a revenue perspective. It's the area that we see as probably the biggest opportunity when I look forward in the kind of medium term. I think you rightly pointed out rail. Other areas that are important to us are water and also transmission. I think we're really encouraged by what we hear in terms of the government's commitment to make progress in that area. But I think we are still seeing things being slower than we would like. Rail is an interesting one. Rail is in the first year of control period 7. It's spending cycle. And we found things slower than we would have liked in that first year. And we're certainly hoping that things ramp up as that enters year 2 in April. Similarly, I mean, I know it's not infrastructure, but similarly in areas like house building, we hear good positive commitments being made, and we welcome changes to planning reform, but we're not yet seeing the activity levels where we would want them to be. I think if I look at other areas of infrastructure, water is an interesting one. We're about to enter AMP8, so Ofwat's the start of Ofwat's 5-year asset management period, and the spending profile for AMP8 is sort of double what AMP7 was. So there's clearly a lot of money going to be spent in that area, and our business is very well positioned to capitalise on that, both in terms of the assets that we have and also the relationships we have with the water companies and with contractors and subcontractors. So we're hopeful that water will be successful for us as we go through AMP8. Transmission is another one that we're quite encouraged by. There's a lot of work happening on the grid, both in the UK and also particularly in mainland Europe. And a lot of our investment at the moment is focused on assets that support transmission. And an example of that is buying steel panels and aluminium panels that we lay down to create temporary roadways between transmission pylons to allow access for the upgrading of the grid. So within transmission, within water, and also within rail, we see a hell of a lot of opportunity for us as a group. We like what we are hearing in terms of the commitment to spending in those areas, but it's not necessarily quite as quick as we would have hoped. Rail, as I said, CP7 was quite slow in its start in year one, but we're hopeful that things will ramp up. And certainly we hear a lot of positivity around spending that's going to be happening across the railways, both in CP7 and more broadly.
John, I mean, VP in a way is a bit of a different beast from some of the other companies we've focused on in depth on this podcast. More capital intensive in a way, and it's slightly more generalist UK focused. But I know obviously the international arms are growing as well. Bet on construction services. Is it kind of a bit of a counterpoint in a way to some of your other focuses or things you might look for in other businesses, or what's the how do you see it fitting in that portfolio and when you rebuilt it 2 years ago?
I think the basic point to make, I don't focus on sectors, as it were. I'm very much focused on individual companies, and therefore, for me, VP ticks a number of boxes, as I said a little bit earlier. I like the fact that it's very well established. It's heavily in the regions. There is a very substantial family shareholding. It's controlled by, I think I'm right in saying, a family. And there is attractive dividend yield. I don't know whether Anna would want to agree with me, but I mean, I think the company really is quite significantly undervalued. And therefore, I'm quite happy to tuck it away in my portfolio. I bought it for all those reasons, plus also I saw an incoming Labour government was committed to greater infrastructure spend, and that obviously was another factor in encouraging me to purchase. I wonder if I may just ask Anna a couple of questions myself.
Please.
Anna, did you say that, was it 50% or 15% you said of revenue came from overseas?
15, so the lower number, 15%.
15, but still a useful... secondly, there were three questions actually. And secondly, in terms of size of company, where would you say you are in the UK? I mean, I would have thought you're almost the leading plant hire company, aren't you?
Yeah, I mean, there are different ways to look at it. I mean, certainly when we look at our listed peers, you have Ashtead, which is obviously a much more significant business, but it has quite a sizable UK operation. And then the other two businesses would be Speedy Hire and HSS. I would say that we are the leading business. And I guess part of the reason I would say that we're the leading business is our level of returns. We're a business that is very consistent and reliable in terms of the returns that it has generated over the years. And we have had this target of return on capital of 15%, certainly over the last 20 years or so. And, through all of the headwinds that we've had in that 20-year period, we've been remarkably consistent in our ability to deliver those returns, which I think stands us in good stead when we compare ourselves to others in the market. I think each of those businesses are slightly different in terms of their focus and their strategy. But from my perspective, it comes down to return level, and that target level of about 15%, I think, demonstrates the reliability of us as a stock.
Sure. And just one final question from me at this stage. You mentioned pylons, I think, and the laying down of walkways. Do you do anything with wind farms at all?
Less so from a direct perspective, but a lot of the work we're doing around transition is helping provide access for the upgrades that are making energy more renewable, which absolutely links into the wind farm. But it's more indirect than direct from a wind farm perspective. But certainly in Germany, where there's a massive upgrade of the grid, there's a lot of work around connecting the grid to the wind farms, and the access that we provide is a big part of that.
So you're getting revenue from Germany. You have activity there. Is that what you're saying?
We do, yes. When I talk about Europe, there are two main areas. One is in Germany, where we're doing a lot of our work, which supports the German transmission market, where there is a very significant opportunity, and I think £500 billion to be spent over a 20-year period. And that's an area where we are putting quite a bit of capex, and we are growing that business. The other area in outside of the UK that's growing is probably the Republic of Ireland, where the market dynamics are quite different to mainland UK, and there's quite a lot of positivity there around some of the specialist construction areas.
I just wanted to touch on current trading and maybe just looking at some of the obstacles to VP's business, both currently and more generally. In terms of labour costs, speed of project commissioning, we briefly touched on, and things like counterparties, solvency. How big are they as risks for a company like yours, or is this the nature of your diversification take care of some of those?
Yeah, I'll start with sort of current trading, and the themes of our current trading are in line with what we talked about when we did our interims back in November. So where we are supporting infrastructure as an end market, things have been pretty positive for us, and we've seen things working well around transmission and around water in particular. Rail's a bit more sluggish than we would hope, but we've still got a reasonable level of momentum there. Where things have been a bit more sluggish, and the areas of the business that are a bit more challenging, are around general construction. So that would probably be our Brandon Hire Station business, where we are more of a regional tool hire business than a sort of more specialist business supporting more significant projects. And we've also found house building to be a little bit sluggish this year as well. Again, hoping that those planning reform changes will start coming through and prove to be fruitful for us. But that diversification that we've got between different end markets does help us overall, because obviously in any given year it's unlikely that all our markets are performing strongly, but we get that natural diversification. From an overall business model perspective, clearly controlling our cost base is a big challenge for us, as it is with every business. We are finding that costs are increasing quickly. The most notable one will be our labour costs, and obviously from the 1st of April we'll have to incur the additional cost through NICs and also national minimum wage, which will have a not insignificant impact on our business. So there's a lot of work being done there to try and offset and mitigate that, which is a bit of a challenge. If we look at others in the market, we were impacted to some extent by ISG when that happened last year, but the direct impact was not significant to us, but it's more the indirect impact and the noises that sends through the market.
And on the question of tariffs, I don't want to be reaching here if it's not something that it impacts you, but I mean, I would have imagined as a company that invests heavily in capex, you're buying specialist equipment, sometimes overseas. Is your purchasing or otherwise your movement of goods affected by sort of tariff noises or tariffs that are coming into place already?
I've been asking this question internally within the business at the moment, and I think at the moment we're in the realms of too early to say. Where we do operate in the EU, obviously there are various EU tariffs with China that are currently in existence, and obviously we are watching closely events in the US in terms of what may or may not happen with tariffs. But at the moment, it's sort of too early to say whether there would be any concrete impact on our business.
Okay. I want to switch lanes, John, and bring you back in to talk a bit more about the dividend. You touched on it as one of the reasons for owning the stock in the first place. For listeners to get a bit more context on that, I think against current market forecasts of 39p a share for the current financial year, or ending this month, March, that works out as a yield of about 7.3%. VP as a business has been paying consistently for more than 30 years. How big a draw is the dividend for you?
Well, I think I would say the dividend is really quite attractive from my point of view. Obviously, it doesn't fall in the category of the very high yielders. I'm talking about M&G on 10% and Legal & General on 10%, Phoenix on about 10%. But nevertheless, to get 7% from a really good, solid, established UK PLC is fine by me. And of course, my VP holding is in my ISA. So it's tax free, and you talk about the dividend record, and so I have no worries about the dividend. And indeed, I was encouraged to see. I think I'm right in saying, Anna, a couple of months ago, or maybe a little bit less, Jeremy Pilkington, the chairman, spent over £1 million, I think I'm right in saying, on buying shares in the business. And I really don't think this is my conclusion anyway. It's not terribly original. I'd be very surprised if he invested that amount of money, even if he's a wealthy man. If there was going to be a sharp decline in business or a reduction in the dividend. So I took that buying to be a positive sign, because I follow directors' share dealings quite closely.
Yeah, I think that's a fair point, and I think that transaction was a statement of intent by our chairman and confidence in the business. I think just on the dividend, we've got a over 30 years uninterrupted track record, which we're very proud of. And I think, John, as you mentioned, it's an important part of the VP story and the attractiveness of our shares. As I'm sure you can imagine, we debate dividends often, and the aim for us is to maintain that track record, but obviously it needs to be affordable and sustainable. And we aim for a dividend cover of around 2. But we recognise that it is an important part of the story. And obviously, and when I speak to investors, the 2 points I will focus on are the returns and the return on capital, 15%, and that 30-year uninterrupted dividend track record.
Anna, just interested to get a bit more of your perspective as CEO there. I mean, you will have loads of claims on your capital or things you could allocate cash towards. The dividend being just one of them. Do you see them, on balance, kind of a necessary agency cost, or are there things that you would be pushing for greater spend versus the dividend with a slightly more long-term focus on returns? Where do you sit?
It's a difficult balance, and we have a clearly stated capital allocation policy, and it's something that we talk about as a board quite often. As a relatively new CEO, and I've got a relatively new senior team, we're not short of ideas, and we want to make sure that we have enough capital to invest and take advantage of market opportunity. But we also recognise the importance of the dividend. So it's a balance. But I think based on the cash generative nature of our business, we can achieve all of those aims, and we can continue to invest in the business to drive growth. But we can also return cash to shareholders at the same time to dividend. But certainly my understanding is that the dividend is an important part of the VP story. But I don't think the dividend means that we are underinvesting elsewhere in the business. And I think if I look at the CapEx that we're spending, we continue to invest significant funds in areas that we think will drive growth and where market opportunity exists. And as I mentioned, that's principally linked to those infrastructure areas.
Yeah. We touched on Jeremy Pilkington, the controlling shareholder chairman, and he was CEO for 23 years, we should add, between 1981 and 2004. He tried to sell the business in April 2022, so getting on for 3 years ago. Couldn't find a buyer and called it off. Anna, I know this process predated your arrival at VP, so I don't want to sort of labour the point here at all because that was in a previous regime. But for some investors who might be a little confused by that relatively recent episode in the corporate history, what's the status now? What should investors conclude or have concluded from this episode?
Yeah, I mean, as you mentioned, I wasn't in the business at that time, and what we have now is new chief executive, quite a new members of the management team. We've got a new refreshed strategy, and we're all quite excited about driving the business forward. And certainly from a board perspective, there are no plans, certainly in the short to medium term, for any sort of similar process. So from my perspective, the focus is all on driving strategy, driving the growth, and making sure that we are well positioned to take advantage of market opportunity. Having Jeremy on the board is great. He has rich experience, rich history, and his corporate memory is fantastic. But he's very supportive of the new team and the new plan and driving the business forward.
John, what was your take on the saga? Was that in the back of your mind at all when you bought back into the company 2 years ago? I mean, that was probably the big news for VP from the year before.
Well, it was certainly a factor, because obviously when you're looking at any prospective investment, prospective stock purchase, I describe it really as like assembling a jigsaw, really, and there are a whole range of different pieces. One is, what state does the board have? Another piece is the company fairly optimistic? Another piece may be the dividend yield. And obviously I was conscious that, the controlling family had announced that they were intending to sell. But of course, at that stage of this is really a key point, that at that stage the shares were around, I think I'm right in saying around £10 or £10, £11, something like that. Now, I don't know, and it's never been disclosed, and obviously I'm not asking, whether there were no buyers or whether there was a buyer, but he wasn't prepared to pay the money that the controlling family thought the business deserved. But nevertheless, the shares at that stage were around double, broad brush, around double the present level of sort of 545, 550, which was another reason for me to believe that the business was and is significantly undervalued.
On that point, it brings us fairly neatly to a bit more of a kind of sector question. Ashtead moving their business to the US, clearly that's where their geographic focus is, Anna, as I think you touched on. Do you share, and maybe we get your thoughts on this, any of their concerns, which I think they stated at the time, and which I think John sounds like he shares, around weak valuations for a business like yours or a sector that you operate in within the UK market? Is that something that keeps you up at night, or you just have to, as CEO, not really worry about the share price, what markets are implying or thinking?
I think on Ashtead first, I mean, their statement talks about, the move over to the US being based on where the bulk of their activities and leadership and people are based. I think kind of leave Ashtead separate. I think from my perspective, does it keep me awake at night? Yes, it does, and it frustrates me. I think UK stocks, particularly small cap, do seem to be undervalued at the moment, and I think we've seen a number of takeover offers in recent months, which probably talks to that. From my perspective, I see our priority to articulate our investment case really clearly, to talk about why we think we're different from others in our sector, and that will be the focus on specialists and execute the strategy and grow the business. I would like to think that if we can do that, our shares will get back to where I think they should be. Some of these points, it's linked to events over in the US, etc., etc. But I would like to think that naturally small cap stocks will move in the right direction certainly in the short to medium term.
I was looking at the shares and some of the forecasts that your various brokers have against those. It kind of implies a bit of a maybe the market's taking a bit of a believe it when they see it approach to forecast, but then I guess that's just down to the company to deliver. John, I know we've talked a lot about UK valuations on this program. Are you kind of happy to sort of sit tight for the long run and in some ways look past? I suppose this is a correcting UK market story in some ways. It's been an encouraging start to the year for some, broadly for the market.
I'm a long-term investor rather than a trader, and if anything, I could be accused of being a bit too loyal to some companies and staying with them. But I'm quite relaxed to have in my portfolio businesses like VP, that are solid, that I believe, and I think Anna was hinting, are undervalued. She believes undervalued, with an attractive dividend yield in the meantime. And I believe the business will grow over a period, and hopefully there will be some sort of market revaluation. I believe that value always comes through in the end in some shape or form, and I'm quite confident that at some stage I will make a profit from my VP holding.
Anna, I'm going to touch on financials and the valuation now, if I may. I don't want to keep you too much longer, but the company often, and I think you did earlier, it cited the return on average capital employed as a useful metric for understanding business, and one I think you said you aim for that kind of 15% mark and have been able to achieve that fairly consistently. Can you just talk us briefly through, is there someone who might not have heard that metric? Help them to understand what the moving parts there, why a 15% ROACE is a positive thing.
So what that metric serves to deliver is to say how much money have we invested in the business and what profits accruedly and what profits have we generated from that. We set 50% 20 or so years ago. And that was set as a point in time, and that's generally been held as our target. It's been held over that 20-year period, and we see that as something that generates sufficient returns to our shareholders. One of the key things from our perspective is how much it costs to borrow money and how much can we generate from the assets we invest. So what we are saying is, for the money that we borrow, we can return 15%. How much does it cost to borrow money? Clearly, it costs a little bit more to borrow money than it did previously. But whilst ever our cost of capital is below that 15%, we are continuing to generate cash and making money for our shareholders. Obviously, we keep a close eye on that gap and that delta between the returns we're generating and the cost of our capital. But at the moment, we're comfortable that 15% is a reasonable level for us to be tracking performance of the business. I also think, as chief executive, it's very useful to be able to look back over a 20-year period where we have one metric that has been calculated in a consistent fashion over a long time period, that you can get that picture of consistency of performance and delivery.
Most of your debt looks like it needs refinancing in the next couple of years. I mean, what's the impact you think that's likely to have on, I suppose, the cost of capital side of the ledger?
We've got a significant headroom on our facilities, but if I was to look at our facilities, there's a third of that element, so 65 million of 190 million will be refinanced within the next 2 years. We're in a fortunate position at the moment that a good chunk of our debt is at fixed rates, and it is probably unlikely that we'll be able to refinance at quite such favourable rates. Obviously, we continue to look at that, and we continue to speak to those that provide our funding to understand what rates may or may not look like in the future. But your assumption that our cost of debt, our cost of capital increases is probably true. Clearly, we will be looking at things like our overall level of debt and our overall level of gearing, because we need to make sure our interest cost is affordable. I think one of the things around our business model is there's a lot of flexibility in it. I mentioned that we are investing quite a lot of capex at the moment because we see market opportunity. If we need to dial that down, we absolutely can do, but it's clearly balanced around the amount of money we'll pay to borrow money and the returns that we can generate in the different markets. I think at the moment we're still comfortable that the gap between returns and cost of capital is sensible and is appropriate, but we will be monitoring that as and when we look to refinance our debt. But it's about a third of our debt that'll be refinanced within 2 years. And like I said, it's unlikely we'll be able to get such low rates, but we'll hopefully be able to manage our interest cost and our gearing appropriately.
Thanks for the correction on that point. I think I did say before there was most. So yeah, a third of the debt needs refinancing. Just one final point, if I may, on the or question on the balance sheet. You touched on being able to sort of respond quite flexibly. It looks like the current ratio for the business has routinely been around 1. I mean, it suggests that the balance sheet is quite finely poised, or you're sort of firing on all cylinders in some ways. What should I take from the flexibility point, that you are able to respond quite nimbly to that? Or is this just the nature of equipment rental, that you're always going to have quite high current assets to current liabilities ratios?
Yeah, I think that structurally it is a function of equipment rental, and I think if you look across at our peers, you'll see that our ratios are not out of kilter with our peers. We tend to look at gearing rather than current ratios, so we're looking at our net debt to EBITDA. And we aim to have a net debt to EBITDA ratio of less than 2, and a happy place is around 1.5. We have plenty of headroom within our current facilities if and when required. I think one of the things that VP has done very well over the last 20 or so years, or possibly even 70, is have a strong balance sheet, and also that sufficient flexibility. And I know when I joined the business, I was quite surprised by quite how much flexibility or ability to be nimble there is with that balance sheet. And when you've got a business that's generating the cash that we are generating, if you dial down that capex as required, that does change the dynamic of the balance sheet quite quickly. Similarly, we've got quite a lot of assets on the balance sheet. As I mentioned, I see our role as custodian of those assets over the life cycle. They are well maintained, they're well looked after, they are young in terms of their age. So we always have that flexibility that we can very quickly dial down capex. And if we needed to realise value more quickly than that, we can realise that through through generating proceeds from asset sales. So I think we have a lot of levers that can be pulled quickly if we needed to, which I think gives me a level of comfort over both our gearing levels and also that current ratio that you referred to.
John, I know you've met with and spoken with Anna in the past. Has it been a source of confidence, this chat to hear?
Oh, it certainly has. I don't think there's anything that Anna said that surprised me at all, as it were. I think from what I heard, it's broad brush, very reassuring and encouraging, and I remain a committed shareholder, and I look forward to long-term growth and recovery in the share price in the fullness of time.
Excellent. Coming to maybe wrap up with a look at a couple of elements of your portfolio since we last spoke. I don't know if you took too much notice of the supermarket income REIT news this week. I think they decided to bring their management in-house. It's not every day we see that for an investment trust or a REIT. What was your reaction?
Well, my reaction was positive to that, and they'd hinted at it before. And what they've made quite clear is that by essentially bringing the management in, and so not having continuing with an outsourced management, which they had before, it will improve the bottom line. I think streamlined management and the overall message from the company as to why they're doing this is positive, and I think we will see certainly a maintenance, if not a slight improvement in the dividend, and they yield, I think, somewhere between 8 and 9%, and also I think they hope and expect to narrow the discount to assets. And of course, interestingly enough, I see that apart from the Americans who have been focusing on trying to narrow the gap in many of our investment trusts between price and NAV, now I think Christopher Mills and a colleague have started a new business called Achilles, which is going to focus on UK companies with a significant discount between price and asset value, and perhaps they might have a look at supermarket REIT.
Interesting. Yeah, there's certainly one to pick up on maybe next time we know a bit more about what Achilles is going to do. Just finally, I mean, defence stocks up a fair bit on geopolitical news, including some of the defence holdings you have in your portfolio. Are there shares in the sector where you're looking to increase your stake?
Yes, very much so. Incidentally, just very quickly, when we did our last podcast, if you remember, I talked about buying Town Centre,
yes,
the property company, with 60% of assets in Leeds, which is where Anna is sitting at the present time. I think I paid 118p for the shares. And they moved up to about 140. So occasionally we get things right, which is quite pleasing.
So your Yorkshire portfolio knows no limits.
Well, absolutely, it's a very solid portfolio. More seriously, on defence stocks, yes, you're absolutely right. But the interesting thing to me is that the way commentators and some investors, when defence stocks are talked about, their knowledge pretty well stops at BA Systems and Babcock and maybe Shemring and Cohort, one or two others. But there are a number of others as well that have significant defence businesses. One is Concurrent, which is doing extremely well, which is one of my favourite holdings, and has a very considerable portion of its output to the US defence major players there. And announced a new product, significant product announcement in the last couple of days. So Concurrent is one. Secondly, Goodwin's. They don't overemphasize their defence interest, but it's very substantial. They're very important manufacturers of significant parts for our Navy, and also particularly our submarine program and the American submarine program. They're very important indeed. So they're going to be a beneficiary. And thirdly, MS International, where I have increased my sharing there, where I used to be on the board years ago. They, I think, are doing very well and should do increasingly well. They are probably now the world leaders in small caliber naval weapon systems, and probably lead suppliers in this area to our Navy, to the American Navy, and to the German Navy, apart from others as well. So, those are three companies. And I've also got Kinetic as well, which has seen a bounce in its shares. So obviously, I have benefited to some extent from the increasing focus on defence, but obviously not as much as had I been invested, say, in BA Systems.
Well, I mean, yeah, plenty to unpack. Maybe next time we speak, we can focus a little bit more on defence. On that note, if you have any questions you'd like to put to John or suggestions for future guests, you can do so by emailing me at alex.newman@ft.com. Until then, all that's left for me to say is to thank you for listening. Thanks so much, Anna, for joining us down the line again. To John, as ever, for your thoughts, and to our producer, Maddie Apthorpe. So until next time, goodbye.